Time for our ETF Spotlight. We're looking into oil this morning as it heads for its biggest gain in more than a week. That's after futures spiked on Friday following the news that Iran had seized this British oil tanker. Joining us this morning with his outlook is CNBC contributor John Kilduff, founding partner at Again Capital. John, good to see you.
Good morning, Carl.
The point's been made a couple times, mostly by Kramer, that given domestic production, you got to go a long way before you get a supply shock. Is that true in this case?
You really do. I've sort of been saying that the U.S. production is acting as a firewall against what otherwise would have been, geopolitical hiccups, nightmares for the market. Also, too, Carl, I would point out that the Saudis have a ton of spare capacity right now because of their efforts to try to bring down global inventories. I mean, they're pumping way below their capacity, so that's another factor there. I mean, obviously, their oil would have to transit the Strait, so it's not as a salve as it might otherwise be, but it's still there.
All right. So that all aside, how serious is this? And why are some people saying that the UK and the U.S. responses have been so measured?
I think because they're not necessarily ready to go full bore on this yet. I think they see the sanctions working extremely well, which is the case. Iran's economy is struggling mightily. Inflation's picking up in a big way there. They're on the ropes. They're on the ropes economically, so it's worth waiting. But also, too, we're not necessarily positioned yet with the sufficient U.S. assets to be able to, if they're going to do the job, do it the way the Army and the armed forces have done the job over the past several times, where there's this overwhelming use of force. I would note that over the weekend, the U.S. military has taken up a presence again in the Prince Sultan Air Base or military base in Saudi Arabia. That is a significant development to me. To the extent they ramp up operations there, that's when this market will get even more nervous, Carl, and factor in, I think, more appreciably a security, a potential U.S.-Iran war risk.
Yeah, I mean, that was sort of my question, John, which is it's hard to predict what kind of Iran tensions actually cause a spike up in oil. I mean, you said yourself it's more subdued now because the U.S. is pumping. So what is the fear scenario for the markets? And how do we know day to day which tensions cause that anxiety that you're talking about?
Right, and there's also the opportunity for a diplomatic breakthrough at any time, an off-ramp of several types, including just negotiations with Iran between the U.S. But I think, Iran has looked pretty weak to me throughout this whole episode now over these past weeks, and I think they had to step up and do something. It would take an actual closure, I think an actual sinking of a tanker, Sarah, rather than a seizure of one. That would be a huge escalation. That would immediately affect and impact transit of other ships. If they could even get insurance, for example, that could shut down the Strait. If the Strait were to get shut down, either directly because of Iran actions or indirectly because it's just too dangerous or sensed to be too dangerous, then that's when this market will go parabolic to the upside. It's going to take that measure, though.
What do we think the Brits are going to say today in this speech of Parliament? And what's the likelihood that Pompeo could put together a global group to police these straits the way he suggested last week?
I think there's a willingness out there to do that. I think the fact that some of the Europeans and the UK were a little slow to come on board with that was why they got that, I think, finger wag from Pompeo this morning. I know India, for example, has offered to send what limited resources they have to the Gulf to ensure the navigability. And I think after this episode, it's going to be a top priority among really all the Western countries, including Japan, who has also offered assets now. So that will come together. Then that will help, I think, stabilize prices as well. As far as what the Brits say, I mean, that they're as caught right now as the Iranians were when the Iranian ship got taken by the UK. What do? Do you go to war over this? No, you don't. Pretty much the conclusion in the market is that we don't see a war break out because of this yet, which is why, again, the price reaction has been so tempered.
Tempered, but still above 60, and it makes you look at the energy stock performance. It's flat today in the S&P. It's down for the month. It's down for the last 3 months. I mean, it's certainly down for the last 12 months, John. Why aren't energy stocks catching a bit off these higher prices?
Yeah, I'm trying to disassociate myself from the energy stocks because they've done so poorly. But seriously, because the prospects aren't good, Sarah, in terms of demand. The demand situation is a really big question mark. And the demand estimates keep getting taken down for the rest of this year and especially next year by just about everybody, especially the International Energy Agency, who in almost unprecedented fashion, after just releasing their monthly report, came out, cut again, and are indicating that they're going to cut their demand outlook further for 2020. And it's all because of the increased amounts of production that continue to come out of the U.S. and Brazil and Gulf of Mexico, not just the shale plays, that continue to oversupply this market in the face of the key demand center, Asia, getting hit hard by the U.S.-China trade war. I heard you guys talking earlier about what the Fed should do in terms of cutting or not cutting. To the extent they're looking at Asia, which the oil market is, there's every justification for 25 to 50 basis points on that regard. If you look at all the economic measures that keep coming out of there, chip trade down, GDP falling, exports falling in Korea, China, Japan. The numbers are terrible.